Now, Intel beat in its fourth quarter, but shares are under pressure after the company provided an outlook that disappointed some investors. We're joined by Matthew Bryson, Managing Director of Equity Research covering enterprise hardware at Wedbush. Thanks very much indeed.
Thanks so much for having me.
You have a neutral on the stock. You say that we didn't hear that much new from Intel, but tell us what were the main new points that the company produced?
Yeah, so Intel last quarter they told us that they were going to be more constrained in Q1, that they just weren't going to be able to ship out of inventory. So revenues are going to be down. When revenues go down, that has an impact on gross margins, and that's what played out. If there was anything new, it was really, in my mind, that there's this opportunity in advanced packaging that might come about in 2027. It might be more meaningful than had previously been thought. But I think they told you pretty much what they said they were going to tell you last quarter.
So it sounds like they just can't keep up with orders. Is that right?
Yeah, no. So that's their problem. They don't have enough capacity. In particular, you're seeing a ton of demand from large customers for server compute, and Intel can't produce enough chips, and they've been shipping out of inventory. So satisfying customer demand with already produced product, and they just don't have any more.
And who makes the product that they sell? Is it manufactured by Taiwan Semi or somebody?
No, in Intel's case, it's coming out of their own fabs on the server side for the most part. So they are constrained by their own manufacturing capacity.
Now, your thesis, I think, if I got it right, is we've seen disappointment today because Intel had this big run-up prior to these numbers. Maybe we can put up a one-year chart again.
I mean, that's exactly it. So I think there was this hope that as Intel gets 18A up, so they start running chips on their own facilities, and instead of having to buy as much content from TSM, that as that node becomes more competitive with what's out there from TSM, that you start seeing margins on those new products begin to look like old Intel margins when they were doing, 60, even 70% gross margins on some products. And I think it's just too early.
Obviously, the perception has been that they're at risk of becoming an also ran in the AI chip out market. What are your thoughts on that?
I think that they are already an also ran. Now, having said that, when you look at what AI is going to drive, right, it's driving more demand for traditional compute. So they still benefit there. That's, in fact, why they have a shortage of server compute right now. And at the device level, it drives demand for more intelligent PCs, smartphones, what have you. And I think they have opportunities there. So I think they benefit from AI. But I think for them to actually be a player in terms of supporting AI, competing with the likes of NVIDIA, that's going to take a whole lot of development work. And we're a long ways away from anything happening on that kind of set of products.
What would make you fall in love with Intel stock or get you switching to a buy?
It's really seeing gross margin improvement and competitive improvement with their new sets of products. So, it's Panther Lake is their first product out on the PC side, but some of the new server products as well, seeing kind of continued trajectory higher in gross margins, which would suggest that yes, they're finally catching back up to TSM, but we're at the start of the journey, and you just can't see it in numbers yet.
Thank you very much, Matthew. Really appreciate it. Matthew Bryson, Managing Director of Equity Research covering enterprise hardware at Wedbush.